All right, guys. So welcome to the call. This is to discuss about the ETFs and the list I have at my end of 15 ETFs. And don't take this as Nimish's guidance, so let's follow blindly. No, doesn't work that way. I don't, when Warren Buffett or someone else, analyst, will list out, I'll listen, I'll pay attention, but my decision, my money, or my money, my decision. So always do that. And it's difficult to predict. Warren Buffett has failed many times. So, but he's successful more because he had kept those stocks for many years, and definitely um, keeping over long term is definitely earns out the risk. So let me share the list. So what I'll do is I'll also flash the Monte Carlo, right? So this is the absolute list. I said, what is that good list? So the scenario is, imagine you, so I'm 52 and you are, say you want to retire, I want to retire
Are
62.
you sharing something? We are not able.
Oh, I'm not. Okay, sorry. Uh, yeah, let me know when you can see it.
Yes, we can see now. Thanks.
Okay, cool. So the scenario is, you are retiring at 60, 55, whatever that time age is. And now you want to play safe and you're going to live 30 more years, 80, 85. So the safety is to make sure you get income for 30 years and then the money you accumulated grows over a certain percentage. So I'm not focusing on distribution part, but I'm focusing on growing part and with a less risk. So the first I put assumption or a rule is I'm going to put only in ETFs. So what are those ETFs? So what I did is the popular ones. So VGT is a technology one. So all of these are Vanguard ones, by the way. I'm a Vanguard guy, but you'll find similar on the Fidelity, Schwab. It doesn't matter. That's not big difference. Vanguard fees have low fees, so that's why I have. And I just like the Vanguard website and everything. Um, so VGT is a technology. We have technology, America's top 500, the value sector, and that's what we were discussing today. Warren Buffett is a value guy, value sector, Walmart, Coca-Cola, Bank of America, and so on. Right. So these are like highly established businesses that the growth has reduced. I mean, they're growing, but not as fast as say AI companies or cloud companies, right? Right. Or cybersecurity. So that's value. The VTI is a total US stock market. And so if you see here, these are the total holdings. So almost 4,000 companies are listed in VTI. All right, this is probably the largest, or there's a 7,895 one. This is the world stocks. Such a huge diversification. So diversification is peace of mind, no doubt. If the whole world goes down, your portfolio goes down. If the whole US goes down, your portfolio goes down, right? So you feel okay. It's not like someone else is coming up, everything is down, so you're down. That gives a good feeling. But depends on what is your target goal. At 62, you want 1 million, 2 million, 5 million, or 500,000, whatever that number is. And where are you right now? What is your current age? You're 45, then you have 15 years to go. So for you to rise up to that target, you really need, maybe you need some risk to get the higher rewards, or you are okay. You just have to maintain that 8-9% average. So it will differ from person to person. But my assumption is at 62 or 60, whatever the retirement age is, how do you play safe using mutual funds? So this is how this list was. So I got real estate also, health sector, growth. So value and versus growth, right? We saw the difference. So this is where the new companies are, small companies are they're growing up. They are going through high borrowing costs because of high interest rates. But there's a lot of speculation. There's a lot of hope. There's a lot of possible potential that this company like Tesla, right, or Apple, Apple, Amazon are slowly moving towards value. But Apple comes out with an EV, then it is definitely going to grow more, right? So this is energy sector, and then these are some popular. Well, these two are some popular retirement funds that 60-40. So 60% is stocks portfolio and 40 are in um, 40 are in bonds. So that's that breakdown. So now of each, this holdings are number of companies, right? So the mutual fund VGT has 370. In that 370, what are those top 10 holdings? How much is that percentage? So VGT has 60% of portfolio is only in top 10. So remaining 360 companies are only 40%. So this is, I mean, it's really concentrated on those top 10, and Apple and Amazon and probably Nvidia is there, Tesla is there, right? So that's what this column is saying. And this is the last 3 years CAGR average, 5 years. And we all know last 10 years are amazing, right? And then you can see, more risk with technology, the returns are high. So 19, 12, 10, and then it goes down. Right. But see, there are some sectors like this. So growth is obviously going up, health is coming up, consumer staples and utilities. Utilities will be always there, right? Electricity, gas company, and all those companies. No matter what happens, you will be paying electric bill. Those companies will sustain any rumbles in the financial situation, right? Consumer staples, people will always drink milk and bread and buy eggs and all that, right? So this is, when there's a recession, this sector will go up. So people will drink Coke, they will not cut down, stuff like that. So but this column tells the long term, and this is all past data, of course. But some of the sectors like staples, utilities, dividend, these are like S&P 500. They are like, the trend is very similar. In other words, in 500 companies portfolio of VOO, if the company is not doing good, they'll kick it out and get another one better performing. So there's always constant revision, and they're doing very good for last 50 years. The S&P 500 index, right? It's almost 9-10% average, right? So last 10 years is 12.2, and since 2010, so that's what, 13 years, 13.30. Right. So our goal is investment. The goal is this. This is normalcy. That's what they're saying. That's the benchmark of all these financial advisors. They'll say, try to at least come to the S&P 500. But what happens is we over diversify. Now, if you put only 10% here and remaining all here, you will not even get 12.2. So you have to decide. And these are so many companies, right? So the super rich guys, billionaires, they usually invest in 50-20 companies. That is the right number, 50, 20, 30. But that Ackman guy is only 8 stocks. So even Warren Buffett says 15 to 20. Motley Fool will say 25 to 30. Right. But here we are super diversified because we are playing safe. Right. So then what I did is, I broke this down into 4 main chunks. All of them top 10 for my calculation, top 10, top 5, and then top 3. And I'm probably going to go with this. I may replace VTV because there's a lot of overlap, 91% overlap. The companies here are already here. And VTV, let's see, how many companies are there in VTV? 346. So my guess is Nancy said 27. 270 companies are existing here. Maybe the top 10 could be different for both the cases, concentration on top 10. But I may change it. I may go to staples or utility. That's my thinking. I could be wrong. Right. So this is the list, and I'll share this. So what now here my focus is, I want to focus in technology. So technology is VGT. I want to focus in top 500 large caps. or large blend, then I'll do VOO. I want to focus on value, which is Warren Buffett and so many, older investors, they like value. This is everything in US. There's only dividend. This is NASDAQ 100. QQQ has an overlap with VGT. They're quite similar. So let's see. I don't have QQQ here or right here. So if you see QQQ, 19, the last 10 years, 17.73, and VGT was 19.46, right? And their top 10%, almost same, 55, 60. So, but QQQ is not only technology, it also goes in other areas. I think it's got some financial ones too, banks. Right. So then I got utilities, staples, real estate portion, right? And so on. So now what I'm doing is if I have a 15 ETF portfolio and I'm going to put equal allocations, so it comes out 6.66%, 6.66% of my portfolio in this, and so on, all of this. If I just do 10, then 10%, and then you got the idea. So 33% for just this three. One of them will be 33.34, right? And then I ran the Monte Carlo. So I'll run one Monte Carlo simulation using VGT, VO, VTV. So let me run this. You guys can see my screen. I think I'm sharing the whole desktop. Okay.
Yes, we can see it.
Okay. All right. So this is the Monte Carlo simulation. Monte Carlo is very popular in investments. Monte Carlo, what it does is at a high level is it adds a variability in the simulation and it creates 10,000 simulation runs. And then it looks at the results of each run and then creates a histogram and then does the probability predictions. So what it does is it inserts the variability. Market can go down, this sector can go down, or this can go up, and all those variations. So there are 10,000 variations. And let's say I'm going to give the tickers, and let's say I have $100,000. I'm not going to withdraw anything. I'm not going to contribute, and we'll simulate for 10 years. Basically, I'm asking, how is this $100 million going to look at after 10 years if I give this tickers? So let's put the tickers. The first one was VOO. Second one was VGT. And let's go with value, VTV. And I put 33, 33, and 33.4, or I can just say equal weight, and it puts for me. So that's 100% portfolio, 100. So $1 million broken down into this proportion, and I'm going to run it. So it did the simulation of 10,000 portfolios with this much initial balance, right? And it looked at the historical pre-tax return of those three ETFs. And added the variable, and the mean return is 14.3, or the CAGR is 13.25. That's the average. That's like, so if I look into the percentile, right? So this is the histogram. So out of 10,000 simulations, say 550, we're saying it's going to grow to 1.5 million. About 900 are saying it's going to be, you're going to have $2 million. And 2.5, this many. So if you add all these counts, it will be 10,000. There are some simulations that are saying you're going to make more than 7 million, but that number is very low. So usually if you see the histogram, if you guys are good in statistics, the mode is that the maximum number of repetition, so which is roughly the mode is here. So, and if you look in terms of percentile, right? So percentile is how they discuss. So percentile is, so let's say, if I say 25th percentile, that means 75% of simulations are saying you're going to make more than 2.597 million. So I'm at the 25th percent number. At 50th, I like 50th percentile. So it's saying 1 million is going to be $3.5 million. The CAGR is 13.42. This is every year on an average, you're going to make this much, considering these three guys, right? Now I can bump it up to say 20 years. And that won't be much difference, but let's see. 13.31 for 20, and you'll have 12 million. So imagine if you just put in this 3 and have patience for 20 years, 12 million is amazing number. And 12 million is today's 7.4 million, right? If you remove the inflation parameter. And maximum drawdown, that means how low can a portfolio go in a year? It's almost 30% or 29%. So last year, the maximum drawdown we saw was 32%. It was really a bad year last year. If you see the history, at 15, 20 years, it was pretty bad. So they are saying that the worst your portfolio could go is 29%. And with that, at 58th percentile with 13.31, you're going to have 12 million. Now, if it was worse than even 29, then of course the number will be less, right? So what I've done is I have captured this number. What is the 50th percentile for this portfolio over 10 years, 20 years, and I think I have 15. And I created, so in this case, so now what they do is in simulation, they add a variability, right? So they use a seed number and they randomize it, right? So this 13.31 over 20 years, if I run this simulation again, the 13.31 will be slightly different. It's 13.37. There'll be some, because they add the randomness, but it will be very close, right? It's still 12.2 million, right? So this number, for example, 13.37 at 50th percentile over 20 years is going to be slightly different than what I have for 3 ETF portfolio. I have for 20 years, 13.29, right? So ignoring the variability, because I ran this in April last month, this is how it looks. So if you had $100 million, whatever that nest egg you have at your retirement age, if you decide to put in this 3, then over 10 years, it is a winner throughout, first of all, over 5, 10, and 15. Because that's less diversity. Diversification is reduced. Now you have our VGT, so 370 companies, and 346, so you're talking about 716 plus VO 500, 716 plus 510, so it's 1336 roughly. About
But there is
14.
also overlap, right?
There's also an overlap, but remember,
Right.
you're if there's an apple here, and probably Apple, maybe not here, but
Right.
the Apple portion is getting more investments now,
Yeah.
right? Your dollar amount is more in Apple. So try not to overlap, because what's the point of diversification then? That's why I'm trying to move out this guy. So maybe if you compare a VGT with, say, consumer staples, there's hardly that many common companies, right? And
Right.
let's do that analysis. So there's
So
a
one question on your assumptions, is this a lump sum 1 million investment or over time?
this
DCA,
is your
dollar cost.
accumulation. So imagine you decided that you're going to quit at 60 working, right?
Mhm.
You're retiring at 60th year. You have $1 million invested across 20 stocks and 15 mutual funds. Now you want to consolidate and play safe,
I see. Okay.
right? Then so what I'm sharing here is what are those possible mutual funds and what could be the combination and what could be the result if we do the simulation,
Okay.
right? So if your 1 million was across, say, 15 stocks and so many ETFs and whatnot, bonds and whatnot, if you do this way, then the forecast over 10,000 is saying you're going to make $12 million over 20 years. So 60, so at 80, you will have this much, right? But you care for, say, 70, so that we'll do it at 70. So the percentage will be same, but the amount will be 3.5 million. That's what you will have after 10 years in this 3.
Hmm.
So what I'm doing is I'm using the percentage returns and I'm adding in this Excel here. So percentage for with the 3 ETF portfolio over 10 years is this. And then see over 15 years, it has gone down. And then over 20, it has further gone down. So it is slowly, gradually plateauing or gradually decreasing. But that's okay. That's not a big variation. But say 5, now I'm adding 2 more ETFs, powerful ETFs. So what are those? So one is VYM and then VTI. So VTI has a lot of overlap with VOO. All these 500 companies are in this because it's a total stock, right? So, but then if you see here, the top 10%, so this is very well diversified fund. It's not super concentrated like VGT. So VTI is there and then VYM. So VYM is probably clashing. Dividend companies are mostly value type companies. So it probably has an overlap with this guy, right? So how do we see the overlap? Right. So I'll send you this raw list and you can add and you can do this, add this, look at the past history. There's a very nice website and it's called Portfolios Lab.
Nimish bhai, can I
Yeah.
ask one question? So
Yeah.
VGT and QQQ, right? Those two are highly, I think, technology focused.
Yeah.
What if you have a position in both of it? I think it will be more overlap, which I do not know how it's going to impact the portfolio if we have both in my portfolio,
So
QQQ and
VGT
VGT.
is that is a very good question. This is asked on the internet many times. So this is the performance. The orange
Hmm.
is the QQQ, and they're almost same. The difference is QQQ is slightly diversified from technology. So, and let's look at the overlap. So 95% assets. So VGT is 95% assets are overlapping QQQ. There is some variance, but 95% is like almost everything is same on both sides. Right. But if you see, and that's a very valid question. I've seen people ask this question, finance. So, and let's do QQQ.
Yeah, because if you are doing like VGT, QQQ, and on top of that, you are doing VOO and VTV, then you should not, in my opinion, you should not carry both because returns, they're almost same. Expense
Right.
ratio for QQQ is more than VGT. So I would put my money on VGT because of the less expense and I can diversify. So basically will roll my QQQ into VGT. That's how I'm thinking.
Yeah. And so many people are saying, but I'll show you the difference. So that's very minor difference. Why did QQ, VGT? And we say here, so we compare with the sector weightings. Right. So technology, 91% in VGT is all technology. Well, it's a technology fund. And then QQQ, it's 49%. See that? And they are diversifying in communication service. So Apple is here. Consumer cyclical is there. Healthcare, 7%, almost 7% is in healthcare. Right. So QQQ performance is matching, but the portfolio is, but if you look at that correlation, there was only 5% delta. So their top 10 are almost same. So see, this is top 10 of
Hey
QQQ.
Nimish bhai, there is a ETF.com.
Yeah.
There, that's a good way to compare side by side. It compares each and every metric. Can you try that? ETF.com.
Yeah, sure. So let me jump there as soon as I'm done here. So see this here. This is all same. There's Visa here in VGT. I think it's QQQ also has Visa, but it's not in top 10. PepsiCo is here, QQQ. I bet you VGT doesn't have PepsiCo. So that's what I'm saying. So, but I mean, right now both the funds are almost performing same. So, what was the website?
Okay.
ETF.com.
ETF.com.
I think, yeah, Slash.
Is this
Yeah,
the
there's
this is
something
what?
called ETF Analytics. Wait a minute. Let me.
That's okay.
Maybe there's a chat window. I'll send the actual link.
Okay.
You
But
can
I
click
like
on that.
this portfolio
Right.
lab is also a good one.
Mhm.
There are some flaws that I found, but if you see here, look, they are also putting the dividend yield, and then Sharpe ratio is there too. So higher Sharpe ratio, we learned today, higher Sharpe ratio is good. So over 5 years, the risk reward. So you see in 2020, the risk reward with VGT was better. So the risk is balanced with the performance, the returns. So here I had to pick VGT versus QQQ in 2020 during Corona time, peak time. This is probably March, January. This was better. But then here in November 7, 2021, QQQ was better. Right. So at point in time, definitely differs, but I don't see even big difference in Sharpe ratio, 1.78 versus 0.9. So it's not a huge, but they're very similar. But the allocations definitely are, see the volatility. This is volatility. It was so volatile in December last year. And now definitely it has, the people have slightly relaxed because rate hikes are going away or tapering down. So this is I like this. It's a short and simple side. There's a correlation table. And then see, Sharpe ratio is there. There are other ratios too for which I had to pay. Expense ratios are there too. So that's one. I'm quite sure there are so many. I'm quite sure there are so many. You can even let's look at the performance. You can create a portfolio and compare to portfolio. You can do analyze. You can analyze the drawdowns. So let's see the drawdowns for these two guys. So how bad, and I'll add actually something else too. The VO and VTV. So drawdowns is how bad did it go? How low did it go? How bad was the drawdown over say 1 year, last 1 year? So that's say, for example, here the benchmark is 25. So this is a portfolio. So basically they're saying if I have all the money scattered across 25% equal distribution, then my portfolio will be, and my portfolio drawdown is 22%, and the S&P was 20.9. Basically mine is pretty volatile. And that's what happened in my case. I'm following NASDAQ. So if you add all your ETFs here and then see how will it sustain the drawdowns compared to S&P 500? You can pick something else too. And it will tell you, okay, what the worst could be me losing this much. And this is actual data. This is past data. So last 1 year. So here at this point, May 19 last year, May 18, portfolio was 2% or 1.5%, not performing better compared to S&P 500, right? So that's that. And say if I remove the value and keep the VOO, and I'll just say I'm holding VGT, and you'll see a bigger debt loss. Look at that. If I had all my money in VGT, then in October 11, 2022, I would have been 35% down, whereas S&P 500 was 25. Okay. So, but then this is the risk. So it's just telling you, you're taking a huge risk here. Right. But if you see it now, that's a drawdown. And if you go and check the performance, so how is my VGT performance compared to S&P 500? And you see the blue is my portfolio with only one VGT. So I'm getting 14.12% as of Friday compared to S&P, you're going only for, so I have 10% more gains. But the swings are bad too, as you can see here, right? So this is just an example analysis. So going back to Excel. So that's what I did. And so from between 3 ETF and 15 ETF, I think this 10 and 15 are overkill in my mind. It's like a wash. It's look at that. 10 ETFs over 10 years and 10 ETFs over 20, same number, 12.5 or 12.58. And same things. So people will say diversification, this, that. I mean, even if you had just one VOO, that may be okay. 500 companies. You have all kinds of companies. Let's look at VOO breakdown. S&P 500. It's across everywhere. And technology is only 26%. There's energy. After technology, it's healthcare, then financial service, banking, and then consumer cyclical. This is perfect. 500 companies, perfect diversification. 500 companies. Warren Buffett says 20 companies. We're doing 500. But we look at only one ticker, VOO. So we treat it like a stock, but you're already diversifying. Right? So over diversification will reduce your portfolio. I don't know what's the right number, what's the right combination, but I look at anything greater than 12%. So VOO, which is S&P 500, last 10 years were 12.20. And if I have the three portfolio, 20 years, I am getting 13%. So it's not right to compare the past data, but I feel I'm more safer if I had to diversify beyond S&P 500, then I'll probably do this too. Add VO and VT and VGT. Some people may only do this 50-50 and not even a third one. If I do that, let's see. If I go Monte Carlo, I think I lost it. 100,000, million. I'm not gonna withdraw anything. The 10 years. And VOO 50 and VGT. Over 10 years, $1 million with just these two ETFs, tracking about 800 companies and of course overlap. 3.8 million. 14.44. Compared to a three portfolio is 13.53. So I'm reducing the VTV. The value is actually lowering down my average. Okay. So that this is a very good simulation tool. You guys should experiment here. And it's got all the historical data, probabilities, look, expected returns. What is the probability of us getting more than 12.5% return over a year? This much. Actually, they're saying VGT has higher chances to make in 1 year than 3 years. The probability is going down. But they are saying you will definitely make 7.5 if you keep it for 3 years. That's 75% chances. Any probability over 70%, that's what the advisors say. Any probability over 70% is as good as 100%. So less than that means there are chances it may not happen. So that's that. And that QQQ. And I'm gonna equalize it. And 14.81, almost same, 3.9 billion. And let's look at the probabilities. So the first 7.5, quite similar. Higher chances of us getting greater than 7.5, and then it goes down. Maybe 10% is possible. 10% is possible over 10 years. Easy. So if you keep the money for 10 years, they're saying we have very high chances of making more than 10%. And then, of course, loss is there. So the loss, if I give a glance, it's no number is greater than 70%. So it looks okay. That percentage loss probabilities are acceptable. There's some risk, of course. And then the histogram. So probably here, the 5,000 total is 10,000. If we add all the counts, 5,000 is probably here, 3.5 million. I think that's what it was. 3.9 million. All right. So now they'll see this perpetual withdrawal rate. That means at 60th year, you can withdraw 10% every year till you die, and you will not run out of money. So they are even suggesting the withdrawal rate. Okay. Anything else? Any other ETFs you guys want to discuss? So I'll send you this. This discussion is needed. See, then I did. So this is 50th percentile. Then I said, what are the extremes? So what is the 10th percentile and what is 90th percentile? So these are the extremes. What is the worst outcome and what is the best outcome? And there's such a big variability. So 3 ETF, basically it's saying in 3 ETF scenario, you can make, in 10 years, you can make as low as 7% and then as high as 19% average on an average, with a 50th percentile of 13.53. So lowest, middle, and extreme high. And then same thing with this. So with a 15 ETF, which is an overkill, I think, maximum you'll get is 14.6%. Whereas with 3 ETFs, maximum, if I see in the board, and the 10th year, you get 19.56. All right. So I think you have to generalize a conclusion that over diversification, because these numbers will slightly change, over diversification will kill your returns. If you want to go for $5 million, then obviously 3.9 is not enough. So it depends on what are your targets, what are your goals. You may be happy with 1 million, then you may go into bonds. Right. So that's what I would say. This is the old analysis. So someone will say, oh, Nimish, you mentioned about all these things. Well, they're here. VGTQQ. I added more because I was researching for my case. I was just, what are popular retirement funds? And, those are the VVIX and VWENX. They're popular. And
I have a quick question. What about, I mean, since I've been hearing a lot that, that the growth of US economy is going to reduce comparatively to the world's, and we should have a little bit at least, and slowly grow our exposure to the world market. And, so what do you think would be an appropriate exposure, percentage of exposure to the world stock index, for example, like the VXUS, so that's a question, because I've been reading a lot of articles and, commentaries about this. So what's your opinion on that?
Yeah, so I'm not able to see the screen. Oh, there you go. All right. Someone wrote a chat too. Okay, that's the ETF.com. Okay, all right, we'll check that. So my opinion, honestly, take it as just an opinion, right? Of course, I'm not expert in future forecasting, but they have been discussing about BRIC. If you know the history on the BRIC countries, that discussion is going for the last 15 years, 20 years. In fact, when I was younger, I put so much money in BRIC and I lost like anything. So I don't know. I don't know. I put money in Russia. I put money in Latin America. I made money in Latin America, and Russia was okay. Russia has oil, so Russia did good.
I
China
think
was
it all comes down to political stability, which none of these countries seem to have.
yeah,
I mean, I would say even including India, things are up in the air, and it's not like a stable government. Like we have only Republicans and Democrats over here in the US. It's more predictable. It's a two-party system. It has worked well so far. Even if a crazy guy like Trump comes, the finance doesn't break and goes like haywire.
yeah.
I think that's what the confidence in the US dollar, even they keep a lot of YouTube videos on de-dollarization, but I don't think it's going to happen anytime soon because there's no stable currency that people would trust. That's the problem. Yeah.
Exactly. You
That's
cannot trust yuan. Russia doesn't want rupees.
yes. Yeah. Russia doesn't want rupees. That's one other article I read that was surprising because they don't know what to invest in and they feel that it's not a good currency. Yeah.
Yeah. And I've done some analysis on GDP, so this is very interesting.
But guys, there is one more thing, like the growth that's happening, the younger population that's happening,
Yeah.
like India, China, Vietnam, South Korea, they have the consumer that spends. US consumer, they are kind of, I would say, just speculating at this point, is like more conservative. But if you go these countries, so in my opinion, if you put like 5% something, 10% like that in the international market, it's kind of a gamble. But I think, like, look at Apple. They're opening stores in India, and as the China is opening, the hope for Apple going up further up is increasing because that's where the majority of the young consumers are. So I think it won't hurt. And again, just an opinion here is to kind of 5-10% of your portfolio. You can not portfolio, but kind of just little bit money in there in the international stocks to see like a wild card.
You can do that, definitely. One thing I'll tell you, IMF has definitely stated that India, China are gonna grow at higher percentage. But think this way. So growth percentage is deceiving. The things that are underdeveloped will definitely grow at a faster rate, right? If the US, let's look at this way. US has so many roads built. US prosperity is good. So there are not many new roads to be built. Whereas other countries, developing countries, there's a lot of growth potential. So of course they're gonna grow at a faster rate. And so I was researching, and this is data coming from the I think BEA group, the Bureau of Economy Analysis. I downloaded the data, and if you see here, and let me look at the. Okay, so let's look at, say, China. This is China. So this data is for since 1961. Okay. So since 1961, these are all percentages. I don't know if you can see. So 1961, so if you see here, so their ramp up started in 80s. So now see percentage here, 5%, 9% growth in a year. 10%, 15% growth in 1 year, 13, right? 14. And then it is, so now we are in 2009. It is gonna slowly taper 9%, 9%, 10%, 9%, 7, right? And I think last column is Corona column, or this one, 2% in Corona, 5% previous. So see, now they are tapering because how much growth they're gonna do? They've grown so much. Rural, urban, China, this, that. Same thing is happening with India. So if I put this on a line chart, this is how it is. So the red is China. I don't see others. Okay, red is China. And it's more up and down. And look at the red line. They were growing like anything for so many years. And it's since 80s, It's constantly up. Even before 80 starts here. This is where their growth story started. And then US is much lower. But US was doing pretty good 50 years back. So who started first? So that's why they say, right? We are developed. And some articles, they say China is not still a developed country. But they are growing. And then this is India. So India, if you see, so this is 8.846% in 1999. Well, 8% of 1.6 trillion. At that time, maybe the GDP of India was 1.6 trillion. Percentage number doesn't matter. Percentage of what? A small amount, right? So our percentages are good, but China is back. The COVID lockdowns are ended, right? So they're going to come back. So IMF is definitely saying that these two countries are going to grow. So I summarized since 1960, the average GDP growth is simply math divided by those 60 years. That growth rate is pretty high. And if I say if this average GDP growth continues yearly, currently that GDP is 17.7 trillion, US is 23. They'll beat us almost after 5 or 6 years. When I say us, meaning US. China and US is almost in 2028. And next 10 years, if they grow at this rate, and 20 years, 93 trillion. Of course, they're going to slow down. But the average will be 8.5 or 8.1, even if they slow down. It's India. India, after 50 years, will do 38 trillion. And these other countries are also growing. US is growing at a slower pace, no doubt, at 3%. Our average is 3%. But 3% of 23 trillion, that's a bigger number. 3% of 23 million versus 5% of 3 trillion. Right. So we have time, but China is much bigger, and China is threat to US. That's what I see here.
And
So
one other thing they're saying is India, even though it's growing, inflation is pretty high.
very
And
high.
it has been high even before COVID. It's not just due to COVID or anything in general.
That's why they get 2 raises in a year.
Exactly. And it's double-digit raises, otherwise they won't stay and they'll keep switching jobs.
Yeah. But if you see this project, I feel that China and India is gonna percentage-wise gonna grow faster than US. So but US currency will remain. I don't see any issues there. There's no alternate. Problem is the Chinese are manipulators. Indian rupee is not that popular, and Brazil real is also not that popular. Brazil is not doing good. So these are actually developing countries getting together to solve that problems. The stronger US dollar is messing them up. So you want to put 20%, 10%, you can put it. But so look, someone mentioned right in the call, in the chat today about international. Last 10 years was horrible. Psychologically, we think, oh, I'm going to diversify my money in this country or that country. I think US is still strong. And if you see Chinese market, that's horrible too. Let's see. Extreme volatility. I don't know if I'm logged in. Yeah, I blast off. Crypto. See, I have created a portfolio retirees fund. I bookmarked it. There you go. So here, Adani, BSC, Nifty. I'm saying, which one is Chinese? There's a Shanghai index, I think. I think this is the one. Yeah. Look at the volatility. This is max. This is since 1997. Scary. Last 5 years, that includes Corona. This compared to US, so last 5 years. Let me, this Zoom toolbar is coming. Right now, they'll show me the futures. So I gotta go to the S&P 500. Well, let's go VOR, which is same. So last 5 years of S&P versus last 5 years of China. There's a lot of volatility at that end. Despite they're growing and they're 17.7 trillion, they're not small. So if you want to go invest outside, be ready with the ups and downs, huge. So, but China, my guess is China will ramp up because the zero COVID policy is gone. And that's why US investors are happy because the supplier issues are gone. There's that Tesla factories won't be impacted. Growth sector will get help from China. So they're positive. It's good news because they're our suppliers. Right. So me saying I'm still US side, globalization is happening. It could be happen completely opposite, right? 5 years, something bad happens in US. Some bad, the default happens. Of course, the whole world will go with us, but default is a bad thing. A default won't happen. It won't happen.
I'm also seeing like a lot of Chinese companies are moving to Mexico because they want to get out of China, right? Like Apple itself got out of China. So Mexico, Laredo, like close to Texas, that's the new Chinese hub. Like every Chinese company is setting up manufacturing over there. It's just a 2-hour drive from Nuevo Laredo to Texas border. That's like going to boom like anything, is what even a Wall Street Journal YouTube video was saying. Yeah, there's a lot of companies going there to set up shop. Even Tesla is.
Yeah, China has made special deals with Russia, Nigeria, Venezuela, Saudi Arabia. So energy sector they are capturing because, and all these other countries like Saudi Arabia, their biggest customer was US and now it's no longer. So they have to sell oil. So they're selling to China. Energy wise, definitely they are very much super powered because they made good relationships. And definitely there's, but then EV sector comes up. That's why I was saying if the US policy may shift, we are slowly going towards EV anyways. Whether
do you see any like
energy
sector ETF, like alternative energy ETF or anything, green energy or EV, anything related to that?
Well, EV sector, that's what I was. So what is that mining? The
lithium
mining is pretty hard. Yeah.
Okay.
Let's see, this is energy. 5 years span. Look at that. So I don't know. I can see it. So see, speculation will be there, and speculation hype. You have to take advantage of the hype, and then get out. Because hype may happen or not happen. So AI is a hype right now. Right now, in 2000, the hype was e-commerce. That bubble burst. Then the same e-commerce came back, right? Everybody's buying online. So e-commerce did succeed. Amazon, Apple. So artificial intelligence will happen unless there's a regulation. The regulatory board, government jumps in and stops. Some bad incidents happen. But other countries they cannot control other countries. So there will be a competitive edge. China is doing AI to decide things. more intelligently than US. That's not going to happen. So, but I think AI, cybersecurity. I think cloud is slowly saturated. And
Do you recommend anything like real estate REITs?
REITs, I don't know. I'm not into real estate. I'm biased, but
No, I'm asking this because like
yeah.
VOO and VGT, there's a plenty of overlap, and bulk of the portfolio is locked up in Apple and Microsoft, right? So um, I know these are two different ETFs, but heavily weighted market cap. So most of the money, at least 40 to 50%, goes to Apple, Microsoft, and maybe Tesla or whatever.
Yeah.
Top three.
And if you buy VGT and VOO, let's see how much percentage of Apple is going. So if you put $100 in VGT, $22 are going
40.
in Apple.
Yeah. The top two itself would take up like 40%.
Yeah. And let's look at VOO. Because Apple is bringing up the average of fund also. The fund managers want that to happen.
Yeah.
So, come on. Kids. There you go. So
Nimish bhai, one more question. Can we put little bit in VUG because that's growth? So if there is an established company, we can kind of, growth has a larger risk, but also good returns. So if you're earlier if you're not at the retirement age, but you can still take advantage of that growth, but it could be an overlap, but I'm just throwing it out.
No, growth sector is doing growth. So growth has a lot of speculation. So this is VUG growth. And look at the holdings, top 10. I think that would also have Apple, Amazon.
That's again
Microsoft.
on Apple and
It's almost
Microsoft.
same list.
You cannot avoid these two guys at least, Apple and
Yeah.
Microsoft. Yeah, it's like
50%, almost 50% is in just 10
bad in
companies.
it, there is nothing bad in it. It's just, but it might pull in some of the newer, younger companies that will give you that little bit more push.
So
as opposed to
$100,
established
$50 are in this top 10. You're getting Home Depot for a change, a different company. And remaining 50 is in on those. I don't know how big is VUG, how many companies. Let's see. $256 companies. So 246 company has your remaining $50. But average, average is good. Look at this 17.49. So you have to compare with S&P 500. It's doing better than even VOO. See this too. Over 10 years. Since inception, 13.3. Since inception, so 2004, 2010. Inception. So growth sector was not, so yeah, mostly growth is better than value. Value will give you dividends. Value is peace. And even Warren Buffett, he's a super strong value guy. He jumped into Apple and his 30% portfolio or something is Apple. Everybody's after Apple. So, so either you buy Apple through VOO or VUG. I mean, all of this probably have Apple somewhere. A top three, probably US stock. Let's say VTI. How much percentage of VTI is Apple? Which is the whole US 4,000 companies. 6%. That's huge compared to the 3,900 companies. So, and that's pulling up the average. So you're stuck with Apple. Apple and Microsoft is also definitely, and they bumped up NVIDIA. NVIDIA, they're adding more allocation to NVIDIA. So, honestly, if you are looking for the list of stocks, These are the top 10. And if you compare with Berkshire or let's see Berkshire. So Berkshire is Warren Buffett. Value mostly. He'll have Coca-Cola and Bank of America and whatnot. Let's see. But he'll have Apple for sure. Wrong one. Holdings. Berkshire Holdings. Well, it's a stock. Well, but Apple 38.9% total portfolio as of 14th February. And look, Bank of America. So he's got everything value and then Apple jumps in. Okay. If you want the value, the VUG or no, value is VTV, I think. This is Warren Buffett's VTV. And if I look at top 10, 1, 2, 3, 4, 6, probably this much. Maximum is in Bank of America and he's into gas companies. Yeah. I don't see Microsoft anywhere here. Maybe it's there. HP is here. Visa is here. Right? So, right. So that's that. But see, now I'm thinking VOO and QQQ is probably a better combination than VGT and QQQ. Because QQQ is diversified across finance and all that too. But overlap is.
But then QQQ has a higher expense ratio. It's, I think, almost double than Vanguard. It's 0.067 or something like that, as opposed to 0.003 for
Actually, it's
Vanguard.
0.2. QQQ is 0.2. I just
0.2. Okay.
Yeah, it's
Okay.
pretty high. Yeah.
That's pretty high. Yeah.
But
Yeah.
I'll tell you one thing, guys. 0.2 versus 1. Don't get lost in this percentage. If the guy is giving you 19%, in this case, both the funds are almost same. So I agree. I always say, don't decide your because of course, see, Warren Buffett and all these people will say about expense because 0.2% of $1 billion will be a huge number. We don't have that issue.
We don't have $1 billion. Warren Buffett. I wouldn't have cared at all.
I mean, they will talk about it because there's millions of fees they're paying. So we don't have that issue. But if you're getting 4% more somewhere else by giving 0.5% more fees, I would give. But high reward will have high risk also. We have to develop patience. Patience. Not many people have patience. That's a problem. They keep on monitoring every day, every hour.
Everybody needs a shortcut to the million dollar class.
Even I was like that. And then I said,
I mean, patience is one thing and strong heart. You shouldn't have heart attacks.
Yeah. I mean, if you see, if you feel last year was horrible for your heart, that is giving a glimpse of your risk tolerance. You should not be in stocks. You should be
individual stocks. Yeah.
Yeah. So if you are getting that signals, take it. Because, I'll tell you, 30% down portfolio on say 500K is 150K loss, right? But imagine if you had 5 million, you lost 1.5 million. That's a huge amount, right? 30%. So your heartbeats will go louder when the portfolio increases. So you have to recognize that, if you cannot handle, because health is also important. So, and I'm telling you, not in stocks, at least 10 stocks, if you 20 stocks, more than 10 will crack, will go down. Look at Zoom. Look at Peloton. Look at all those Corona stocks at the stay-home stocks. Zillow, Open Door. Yeah, it's a things changed. Suddenly out of blue, Corona came. Suddenly out of blue, Ukraine war came. What's next? So 30-40% of your portfolio will constantly go through this. And then it may come back to Peloton may come back if Amazon buys them or put some money. So that Nikola was so popular, Nikola went down less than $1 now. I lost money there. Marijuana stocks, they went up when Democrats won, when Trump lost, thinking Democrats will pass a bill and legalize marijuana. And some states are already legalized, Colorado and whatnot. Canada is legalized. But Republicans won't pass that bill. So marijuana is down. Wrong. Anyway. All right. So I can definitely pass on this Excel. Not a rocket science. It's, of course, these are all Vanguard. I'm more confused here. Maybe this too. I don't want to go here. But some people, if you have good amount collected, and if you're young, you should play safe. 8-9% is enough. And this analysis, Monte Carlo, keep on doing it, will help you. It will put your numbers, put your holdings, and you'll get a glimpse on your future. And then that retirement Excel that I created, put that number at 60. If you have 1 million, 3 million, 5 million, whatever the number is, and if you withdraw 4%, how much will be at the end of 30 years when you die? How much will your kids get? There's that. You withdraw 4% and the portfolio now. So just imagine you have, it's a $3 million example. And I would put here and just stay cool. All you care is not even 13, 14, only need 9%, 10%. Because you are withdrawing 4%. You're withdrawing 4% and the portfolio is increasing 9%. So money is it's gonna grow, right? So you never run out. In fact, your kids will get more money. Right? And 4% of 3 million is 120K. If you paid off your home, if you have 2 social securities or 1 social security coming, yeah. So let's say 3,000 a month. So $13,000. And house is paid off. Plus, you don't have to do 401K when you retire. So anyway, I think you guys will be fine because getting this education, so you will prepare.
Do you have any brokerage recommendation for automatic monthly like installments?
We discussed,
Automatic.
I think Fidelity does mutual funds.
Okay.
If you buy, say, so these guys have equivalent mutual funds. So for example, VGT is VITEX.
Mm-hmm.
So if in Fidelity, and Fidelity has its own also technology funds. So if you buy 3-4 funds that you like, and if you want to auto invest every month, $100-$200 in each,
Mm-hmm.
you can do that in Fidelity. I think their condition is first you have to have those funds in your portfolio.
Oh,
you
just buy the first time and then subsequent things you can set up.
Yeah.
Okay.
I used to do that. I did for many years. And I was a mutual fund guy. So then now more stocks, but mutual fund. So there's they call it, what do they call it?
Like how is the expense ratio for those? I never invested in mutual funds. So
pretty standard is Fidelity auto investment. They'll tell you, but the S&P 500 is same as Vanguard's S&P 500.
Okay.
They're very competitive. So Fidelity investments. There you go. So here. Yeah, I would say the best way to enforce discipline is auto investments, automatic investments. Every month, you can even distribute the proportion. The 30% goes into this one, 20 here, and remaining here, and it will withdraw from your. So I think it's like a push mechanism. It pushes from your bank to Fidelity, and then from Fidelity's cash reserve, it gets invested.
Mhm.
So it's pretty straightforward. And if you call them, the chat and the phone is pretty good.
Okay. Okay.
Yeah. I encourage everyone to do auto investments. And I'm assuming that you're maxing out your 401k first, all that, and then extra
Yeah,
money.
the HSA. Yes.
Yeah. I just say I'm taking a risk. I'm putting in Tesla and Nvidia and whatnot. So, small amounts, you can take a risk. Big amounts, play safe. Small amounts, let's say $500 every month you're doing, you can take some risk. Worst come worst, you'll lose 500. You won't lose 500, but I'm just saying. Oh. All right. Anything else, guys? If you guys have a list, yeah, but I mean, this basically covers all major sectors. Some people, you think from diversity, you think, oh, I gotta put in real estate. Then be ready with this is the history. This is the history of VNQ. And just because you wanted diversity, you agreed to do it 7.43 average. It's going to lower down your whole portfolio. That could happen with international stocks or bonds. So where people are, and I also made a mistake. Yeah, let's do this math. So you have, let's say you do our math, doing math here, 50, 10. And I'm sorry, I'm just speaking real estate, but it could be something else also. I'm say, okay, I'm going to put 40 here. So till here, the average was 19%. And then here, that it went down below. Or say till here, the average was 14, 15%. And then here, as soon as you added here, your total portfolio average went down to 8% or 9%. That's what happened to me. Because I was so busy diversifying. But where are you diversifying? Because psychologically, I was saying, okay, technology, America's best companies. Let's put in international. I was international guy waited so many years, and that reduced my average. So this is a guy that contributes lowering your average. If you really want big money at 60, till 60, you have to play a really aggressive game. That's what I think. If you want $3 or $5 million, you have to have high returns every year. If S&P, so last year was bad, but prior to that, I think it was 30%. 30%, let's see. Where do I have calculators? Market research. College ETF strategy, stock market performance. See this. There you go. So since 1975, so 2 years back, S&P was, Corona year was 16%, year prior to that was 30%. Now you are so good at diversification that your average, forget, you're supposed to get 30%. Remember, this is our benchmark. But you are stuck at 9%, 8%. When is 30? You have to make 30 or more. Because these days don't come that often. That's why I was saying, if international last 10, 15 years so good, and you put parked in international and you got 13% over 20 years, then you wasted all this. So you had $1.5 million in 2009, right? That became $5.4 million in 2022 after 19% loss in the reduction. The S&P went down 20%. But if you had an international, you would probably would have 1.5 would have become, so 13% of 1.5, 150, so 1.655. So but we cannot predict, definitely. You have to substantiate by data and all those things. And you cannot predict geopolitical issues also. So if you want to put 10, 20% in international, then yeah. Okay, guys. I've seen one last thing I'll say is, if you're confused between two options, do 50-50. If you have 100 stocks and if you're confused whether shall I, and the stock price has gone up, and you're confused whether to sell or hold, then sell only 50%. Anywhere you have, take a middle path. That's what I would say. Yes, somebody was saying something.
I was just saying that I have a list of ETFs recommended by Value Line and Motley Fool. I will share that in our WhatsApp group if that's okay.
Yeah, we have so our strategy is, and I'll do a Venn diagram someday. So think this way. Motley Fool is saying top 20. These are top 20. For example, okay. Motley Fool has more than 500. But let's say for them, this are the best. Their stock advisor service, 50 stocks are listed. Then some other Soaring, what was that? Soaring Eagle or something, some other website. They are also advisory. They'll say I have some lists. Then the media, then our research. So I have these 3 circles, 4 circles, and see how it falls. And what are those common companies across all those 4? I would buy that because these guys have analyzed like anything. They're much smarter than us. So best of the best. That's what I'm doing. So for fundamental analysis, technical analysis, you should know because so you can understand the numbers. Best of the best. And so once you have that best of the best, so it could be 100 from this company, 100 from this, 100 from your research, Forbes and this and that, Barron's, and then you look at that, the union query, right? Or that common area in the Venn diagram. If you extract that and you have, say, 30 stocks, then now you use your gut feeling, you do your research fundamental and narrow it down to 20. That's a safer approach. Does that guarantee a huge returns? I don't think so. No one can guarantee that. But at least you're not doing an idiotic mistake. At least you have some confidence that the massive research was done and all industry is pointing there. So let me look at Singu's link.
Hey, Nimish, sorry, I have to drop off. Thanks a lot for your session.
Yeah.
Yeah,
This is good. I'll bookmark this. So
I mean, yeah, if you Google, you will find many websites comparing like that. This is like side by side, so it's more easier to look at the data.
oh,
like
definitely. Yeah. Oh, I see this is dark holdings and all that. I like this donut chart. Yeah. Okay, guys. Talk to you guys later.
Yeah.
All right.
Thank you. Thanks.
Thanks, guys. Bye.
Are you going to send the spreadsheet that you have?
I'll send you. Yeah.
Okay.
Okay. Bye.
Bye.
Bye.